In the world of manufacturing, one of the most critical aspects that businesses need to keep a close eye on is variances, specifically unfavorable variances. Now, if you're in the manufacturing sector, you've probably encountered these variances, and if you haven't, let me tell you, they can be a real headache. So, what exactly are these unfavorable variances, and why should you care? Well, buckle up, because we're about to dive deep into this topic. First off, let's define what we mean by manufacturing variances. At its core, a manufacturing variance is the difference between the expected cost of producing goods and the actual costs incurred during production. Picture this. You've set a budget for your manufacturing process, anticipating certain costs based on historical data, market trends, and maybe a bit of wishful thinking. But then reality hits, and your actual costs come in higher than expected. That, my friends, is an unfavorable variance, and it can send shockwaves through your financial forecasts. Now, why do these variances happen? Well, they can stem from a variety of factors. Sometimes, it's simply due to higher expenses. Maybe the cost of raw materials skyrocketed unexpectedly, or labor costs increased due to overtime requirements. Other times, it might be lower revenue than anticipated, which can occur if sales don't meet projections due to market shifts or increased competition. In essence, unfavorable variances are like warning signals, alerting management that something isn't quite right. Let's break this down a bit further. Imagine you're running a factory that produces widgets. You've budgeted $200,000 for production costs, expecting to sell enough widgets to cover that cost and then some. But at the end of the month, you realize you've spent $250,000. That's a $50,000 unfavorable variance. Now, that's not just a number on a spreadsheet. It represents real challenges that need addressing. It could mean you're not pricing your products correctly, or perhaps your production process is inefficient. Either way, it's an issue that needs your attention. And here's the kicker. Unfavorable variances don't always mean you're in the red. Sometimes they simply indicate that your profits are lower than expected. For instance, if you budgeted for a net income of $100,000 but only made $80,000, that's an unfavorable variance of $20,000. Sure, you're still making money. But you're not hitting those ambitious targets you set for yourself. This is why understanding these variances is crucial for any manufacturing business aiming to expand sales and enhance profit margins. Now let's talk about the types of unfavorable variances you might encounter. One common type is the sales variance. This occurs when your actual sales fall short of what you projected. Maybe you didn't hire enough salespeople, or perhaps your marketing efforts didn't create the buzz you were hoping for. Whatever the reason, this variance can be a wake-up call to reassess your sales strategies and maybe even boost your marketing campaigns. Then there's the labor variance. This type can be split into two categories: labor rate variance and labor usage variance. The labor rate variance looks at the difference between what you expected to pay your workers versus what you actually paid. If you budgeted $20 an hour but ended up paying $25, that's a labor rate variance that needs investigating. On the other hand, labor usage variance examines the efficiency of your workforce. If you expected your team to complete a task in 10 hours, but it took them 15, that's an efficiency issue that could point to training needs or process improvements. Let's not forget about material variances either. These occur when the cost of raw materials fluctuate, or when there's a discrepancy between the amount of materials you plan to use versus what you actually used. If you budgeted for a certain quantity of steel to produce your widgets, but ended up using significantly more, that's a material usage variance. This could indicate waste in your production process or issues with your supply chain. So, what causes these unfavorable variances? Well, they can be attributed to a range of factors, including economic changes, market conditions, or even internal inefficiencies. For example, if a recession hits and consumer spending drops, you might see a decline in sales, leading to an unfavorable variance. Similarly, if a new competitor enters the market with a more innovative product, you might find your sales figures falling short of expectations. Now, here's where things get serious. When unfavorable variances occur, it's crucial for management to investigate and identify the root causes. It's not enough to just acknowledge that something went wrong. You need to understand why it went wrong. This is where variance analysis comes into play. By analyzing the data, you can pinpoint specific areas that need improvement, whether it's adjusting your pricing strategy, optimizing your production process, or enhancing your marketing efforts. Let's take a real-world example to illustrate this point. Say your company projected sales of $200,000 for the quarter, but you only hit $150,000. That's a $50,000 unfavorable sales variance. Upon analysis, you discover that your competitor launched a new product that stole market share. This insight allows you to pivot your strategy. Perhaps you need to innovate your product line or ramp up your advertising to regain lost customers. Another example could involve a manufacturing company that planned to spend $100,000 on raw materials, but ended up spending $120,000. Upon investigation, you might find that a supplier raised prices unexpectedly. This could prompt you to explore alternative suppliers or negotiate better contracts to mitigate future risks. The truth is, unfavorable variances are not just numbers, they're opportunities for growth and improvement. They force you to take a hard look at your processes, your pricing, and your overall business strategy. Now, let's talk about how to effectively manage these variances. First and foremost, it's essential to have a solid budgeting process in place. A budget is more than just a financial plan. It's a roadmap for your business. It allows you to project income and costs, helping you to make informed decisions about where to allocate resources. Regularly reviewing your budget against actual performance is key. Monthly or quarterly reviews can help you catch unfavorable variances early, allowing you to take corrective action before they spiral out of control. This proactive approach can save your business from larger financial issues down the line. Another important aspect is communication. Ensure that all departments, engineering, finance, production, are on the same page. When everyone understands the budget and the importance of minimizing variances, it fosters a culture of accountability. Encourage teams to share insights and collaborate on solutions. Investing in technology can also play a significant role in managing variances. Modern ERP systems can provide real-time data on production costs, labor usage, and material expenses. This data is invaluable for identifying variances quickly and accurately, enabling you to make informed decisions on the fly. Finally, don't shy away from training and development. Equip your team with the skills they need to optimize processes and reduce waste. Whether it's through workshops, online courses, or mentorship programs, investing in your workforce can lead to significant improvements in efficiency and productivity. In conclusion, unfavorable variances in manufacturing are a reality that every business faces at some point. But instead of viewing them as setbacks, consider them as opportunities for growth and improvement. By understanding the causes of these variances, implementing effective budgeting practices, fostering communication, leveraging technology, and investing in your team, you can turn unfavorable variances into valuable lessons that propel your business forward. Remember, every variance is a chance to learn, adapt, and ultimately succeed in the competitive world of manufacturing. So, embrace the challenge, and let's make those variances work for us.